delighted to kick off the first panel here. These three gentlemen don't need any introduction, but I will go ahead and provide a brief introduction. Chris Concannon is CEO of BATS Global Markets. As CEO, he leads a publicly held company that is operator of the #1 market for the trading of European equities, US equities, excluding auctions, and ETFs, as well as a growing US options market. BATS has been a great supporter of the center, and thank you for that, Chris. Next to Chris is Tom Farley, president of the New York Stock Exchange Group, which includes the New York Stock Exchange and a diverse range of equity and equity options exchanges, all wholly owned subsidiaries of the ICE. I guess the most important introduction for Tom is he's a Hoya. And if you didn't know, he played baseball while at Georgetown.
I think we're sitting on third base right now. For those of you who weren't around, it was this gorgeous field. Now it's this beautiful auditorium.
That's right. As a senior, Tom put himself in the Georgetown single-season record books with 56 games started and 49 walks. He's still ranked right at the top there in terms of number of games played, games started, walks, RBIs, and on and on.
Can you keep going? And how do you do academically?
We won't talk about Tom's grades.
Good, mercifully.
It seems like he did pretty well. He got good education here. And Tom Wittman is Executive Vice President of Nasdaq, Global Head of Equities. Tom oversees the global cash equities and equity derivatives businesses. And Tom, we've actually had a very long-term partnership with Nasdaq going back to the early 90s. So, but delighted to have all three of you here. So let me start off with sort of a broader question, issue. Our exchanges have changed dramatically in the last 15, 20 years. And I think one of the triggers was the exchanges, not just in the US, but all around the world, demutualizing. And exchanges became for-profit. All three of your exchanges are now listed companies. What changed in the last 20 years? And if you look through your crystal ball, what do you expect changing in the next 10 years? Whoever wants to start.
I mean, I look at the mutual structure, and if you look at history, there were more problems with the mutualized structure than the demutualized structure because members were running exchanges at the time. And that's really what the exchanges were criticized for. And there were investigations and lots of accusations. So when people critique the for-profit exchanges, I think, well, it wasn't so good when it wasn't for-profit. I really think technology obviously changed our industry. It changed how our markets function. And it made exchanges become much more commercial because if you look back, a lot of the ATSs were growing throughout history faster than the exchanges were. And literally each one of us at the base of what we do was an ATS. So NYC bought ARCA, NASDAQ bought Instinet, and BATS was an ATS before it became an exchange. So it's really that commercial entrepreneurship that is at really the base of the technology that supports all three of us. And I think it was really so the technology and demutualization was forced because of the history of the mutual structure.
So I lived the days of the Philadelphia Stock Exchange, which was the first exchange in the U.S., and what Chris is saying is absolutely true. So it was run by the members, and I think we made a lot of bad decisions because the members were the ones that were influencing the decisions. And so when we became the mutualized process, we started to make better decisions. The Nasdaq buys, Phillips to diversify, and a big part of that was technology, leveraging technologies. And of course, these companies, the three of ours, are much more global. So we are equity exchanges, we are options exchanges, we're getting into different asset classes, into futures. So I think as far as the future, you need to continue to diversify both in asset classes and in geography, which, we are all doing, and that's the way we compete. We're not, even though it's Nasdaq, and you think of it as a Nasdaq stock exchange and Nasdaq stock market, we are much more than that. We're a technology company. We're global. We've got great businesses to support, but I think the future is going to continue to be diversification and technology usage.
I'll come at the question from a slightly different direction. And first, I just want to say thank you for having me here. I do love this place. I walked from Wisconsin and M up here and just had a smile on my face the whole way. I walked past Weismiller's, which is the site of one of the most important sites in my life, because in 1995, I went in post-workout to buy a Gatorade. They were 99 cents, and I didn't have $1. And I walked out, and there was a beautiful, smiling young lady standing with a friend of mine. I said, I'm out of money, and this woman pulled out $1. I'd never met her before, and fast forward, we've been married for a long time. We have 3 girls. So that was her first lesson in finance, I guess. That was.
Are you still borrowing money from her?
Yes.
I thought he was going to ask us for $1.
So Reena, when I came in, you were speaking about the importance to society of finance, and to kind of maybe take a step back and then get to the meat of your question. I loved what you were saying at this great place of formation for young people, saying, hey, look, for society, finance is very important. And to go a step further, free enterprise, with apologies to the Jesuits perhaps, free enterprise is the greatest force for good the world has ever known. And in my lifetime, poverty has declined by 80%. People living under $1 a day, apropos of our dollar conversation, has gone down by 80%. And that's free enterprise. That's increased trade, increased globalization, increased respect for entrepreneurial zeal. And when I think about the history of the New York Stock Exchange, nearly every great innovation over the last 224 years that has improved lives all throughout the world has come through the New York Stock Exchange, and we've helped in some small way, helped them raise money. In 1903, Sears and Roebuck getting started, or Henry Ford mass producing the vehicle, and all of a sudden, if you're a woman in a rural area who's about to have a difficult delivery, you can jump in a car and drive to a hospital. I mean, really life-changing stuff. And free enterprise is this, when done right, and really it's been perfected. There's still room for improvement, but the greatest version of it here is in the United States. It's a perpetual motion machine for goodness, and when you get to the middle of that perpetual motion machine, you find exchanges. And this idea of kind of socializing investment costs in companies really didn't arise until a few hundred years ago, and it works just fabulously in this country. And nothing has changed in 224 years at the stock exchange or in a more recent period at Nasdaq, which is to say the primary goal of exchanges, your question was 20 years, I'm saying 220 years, is to raise money for great entrepreneurs to make the world a better place. As a secondary objective of exchanges, it's to provide a secondary marketplace for trading so that those investors, those primary investors who are going to invest in the great idea or the great entrepreneur, have confidence that, hey, if I change my mind in the future and I need to sell some stock or I need to balance my portfolio, I'll be able to do so. And so I think the role of exchanges has changed very, very little over the last 20 years. It's really just technology that's given it a different face or veneer.
So sort of pushing on that question a little bit more, what kinds of changes do you expect in the future? Is it technology that's going to keep pushing the changes? What about globalization? Is there a next step to globalization?
I think the advancements that we're seeing in our market is less about market structure, although we tend to talk a lot about it. But it's really around portfolios and the sophistication of putting portfolios together that only, I would say, higher end net worth people would have access to. We're now putting that into a computer algorithm and making it available for the $10,000 account. So the ability to get access to more sophisticated investment intelligence is being really democratized, whether it's you call it a robo-advisor or most of the big retail firms now have this portfolio optimization, and it's just technology has allowed what you'd spend money on with a sophisticated advisor putting together a package of either options or different types of portfolios it's now available to someone that can just put $10,000 in an account. And that's, I think the innovation in our space is coming from outside the market structure space, although we spend too much time on it. So it's products that we're selling to people, like the ETFs, and it's also what the advisors are doing and how they're converting through technology into a much more sophisticated offering.
Yeah, with respect to globalization, I think globalization is at full speed, and we at Nasdaq don't just compete vigorously for operating companies, listings of operating companies based in the U.S., but we also do so for global companies. They list here. American investors invest abroad every day, and investors from around the world invest in the U.S. There's more to do, and there's still barriers to foreign investment, and there's still politics around exchanges. Every country has, an army, a flag, and a stock exchange, and so inevitably you get a lot of politics around exchanges, but globalization is in full swing. I agree with Chris's comments, and I'll add, I hope, and it's my belief, that innovation over the next 10 years will be about simplification. The markets are just very hard to understand for the common investor or the head of an exchange, quite frankly. I think it was Commissioner Pivovar was discussing August 24th last year, that day of extraordinary volatility, and then, in fact, a period of several weeks of extraordinary volatility. And he was saying that people couldn't even figure out kind of what happened. What was the problem? And there was weeks, months, and now we're into years of people kind of guessing, was it this or that? And that's a symptom of how complex the markets are. They've only gotten more complex recently with the advent of kind of new exchange models. And it feels like we're catering to this complexity, and I'm hopeful that innovation will reverse that and make it simpler and more approachable, and ultimately that'll make for a more inclusive and liquid marketplace.
Commissioner Pivovar also spoke about fixed income, and so, I know a little bit about the e-speed environment and treasuries, and I think what we need to do going forward with different asset classes is to take some market structure things that we've learned over the past, the good and the bad, and apply that to some of these products that have less transparency, less visibility, and bring something new to the marketplace in these different asset classes. And then also with some of the European markets, they talked a little bit about the access fees. In the Nordic markets that we run and operate in Europe in general have a completely different pricing scheme, notional pricing versus make-take, and it's we could probably learn from that as we move forward with the tick pilot and the access fee pilot and make some changes around those things. Even our equity options markets in the U.S. are different than our equity markets in the U.S. So we'll learn from that.
Each of you and Commissioner Pivovar have talked about a little bit, the whole capital raising process. There's a person in the audience who was in the very first class I ever taught at Georgetown when I joined. And I remember at that time I used to go around saying to my students that maybe most people don't remember, but companies like Netscape in the 80s could only go public on a US exchange because we were so good at fostering innovation, entrepreneurship. Do you get concerned that the number of listed companies has dropped dramatically in the last 20 years? Or are there other sources of capital? Is private equity playing a role? Now we see different types of companies getting listed, and fewer companies are listed.
Let me go first. They're going to get tired of you going first.
Yeah, no, let's mix it up.
Okay.
Yeah, and we don't do listings.
So the...
I have some thoughts, though.
Okay. All right, I'll pass it to you. Just relax. Just relax. So the number of public companies is down broadly about half over the last 20 years, but I feel the need to be devil's advocate because of the way the question was framed. It is a concern of mine, but I want to be devil's advocate for a moment. At the same time, the market cap of U.S. listed companies has increased by about 3 times, which is to say the average public company has increased by about 6 times. Because if you cut the number in half and you multiply the market cap by 3. So what's really happened is the markets haven't broken as a vehicle for listing or capital raising, and we still raise anywhere on the New York Stock Exchange $200 to $300 billion a year in IPOs and follow-ons combined. That's a really meaty figure, some years even greater. 2 years ago, I think it was closer to 400 billion. But what's happening is larger companies are public. And that's something that you heard Commissioner Pivovar discuss, although I did hear him caveat saying, hey, if the markets aren't as approachable for smaller companies. They absolutely are not. And a lot of the market structure that we've put in place over the last 15 years, while well-intentioned and well-meaning, has really benefited the largest, most liquid stocks, and it no longer benefits a smaller company, to be public in the same way that it did previously. And so that's why the way we're thinking about it is the changes that we want to put in place are more about how do you provide better markets for lesser liquid companies, how do you create a more simplified listing process for smaller companies, as opposed to, hey, how do we make the markets more appealing for Alibaba? Because when Alibaba goes public at $200 billion of market cap, immediately they had a very tight spread, very tight bid offer, very deep books. I mean, the capital formation was immediate, instant, and complete, and you don't see the same thing for smaller companies.
My thought, and I agree with Tom on all of that, it is hard for companies to go public. We've made it hard given the regulatory costs and the litigation costs that they have to deal with. But more importantly, I think we're in a world of easy money where rates are close to zero. Small companies can access the debt market, so they are borrowing money. But more importantly, there's so much money chasing higher returns. If you look at the amount of capital that was redirected to the venture capital funds, it is off the charts. So you have money sitting in VCs that are now funding what I think is a private company bubble. If you look at the number of unicorns that exist in just the US alone, we're talking over 150 a billion plus private company valuations. And those companies actually can't go public because our public markets are too disciplined. And they'll never give them that same valuation that they're getting in the private market. And what we're seeing right now, and you're hearing it from these private companies, is they're burning through so much cash, and the VCs aren't giving them more money. And so they're in this valuation trap where they're technically a unicorn in the private market, but if they walk into these two markets, the investors are going to be much more disciplined. And it's the first time you'll see, I mean, if you brought up Netscape, that was a bubble that burst on our markets, and we all experienced it. There's this quiet bubble bursting in the unicorn market today that luckily all investors aren't feeling. Mostly high net worth people are feeling through their venture capital investments.
So the Nasdaq private market is a way to try to incubate some of those unicorns that Chris talked about. And I agree with what Tom said about the market cap of the companies going public now. But still, you know, the whole process of these companies IPO and becoming public, creating more jobs, generating cash and money, looking to make acquisitions after that. I mean, these companies are so excited when they come to Nasdaq. They go through this process, and we do see a pipeline of IPOs coming, but this Nasdaq private market is a way to kind of incubate and keep a foot in that arena at the same time, continue with the larger IPO business.
Can I just make one more point? And Chris is talking about these unicorns and the notion of money going into VC, and that is to say a lot of these great tech companies, but other high growth companies, non-tech, are going public later. That's sad to me. When you look at Microsoft that went public much earlier, they created tremendous wealth for the retail investor, for Jack Farley, retiree in Prince George's County, whereas Airbnb or Uber sitting there with a $30 to $60 billion pre-tax valuation. Largely, that wealth has been created for very sophisticated, very wealthy people. And I don't begrudge them making that sort of money, but boy, wouldn't we all like to see more inclusive growth. And this is one way to achieve that.
So regulation is one issue that's keeping companies from going public sooner. And market structure might be another issue. In your mind, has the Jobs Act served much of a purpose?
Yeah, I think Jobs Act's been really good. Specifically, one of the facets of the Jobs Act allows for companies below a certain size threshold to file privately. If you're a private company, high growth, you're considering an IPO, one of the reasons you're fearful of an IPO is that you now have to disclose to your competitors exactly what your financials are and your strategy and so on and so forth. And when Bats filed to go public, I was probably the first person on the SEC website pulling down their prospectus, reading through it, and trying to glean any nugget that I possibly could, or Nasdaq say on their earnings calls, reading through the transcript. And my competitors do that to me as well.
No, I actually don't.
Oh, really? might help you.
I just noticed how expensive you are.
You should have went to Georgetown.
They didn't teach that course at Catholic. My mother went to Catholic, so. But I don't even remember where I was. I pass. But anyway, what the Jobs Act feature does is it allows you to file confidentially, and you don't have to disclose to the world your inner workings until you decide to pull the trigger on your IPO. And hundreds of companies have availed themselves of that. So that, to me, is a good thing. And there's probably some companies that have chosen to go public that otherwise would not have if they hadn't been able to, in the first instance, file confidentially.
Yeah, no, it's a great point. And I think, once these smaller companies go public, we're trying to do different things in order to try to liquefy their stocks. I think it's been more and more difficult to get the market-making groups to commit capital and make a market in a lot of these stocks. We're trying to create programs, either rebate incentives and different programs to incent them. Of course, Chris could probably talk about this from his previous life at Virtu, but all these companies, it's a big investment to have technology and be in stocks that may only trade 20 times a day. So there are a few that are committed to providing capital there, but it's more and more, it's tough to get 5 or 10 firms to liquefy the book.
Commissioner POR and Professor Angel discussed ETFs and ETPs, and he was quite positive, I thought. He was trying to say that the problems that we had in August last year are probably not going to happen again because of changes that have taken place. What's your sense? Where are we?
On August 24th, I think the one difference between August 24th and the flash crash of 2010 is the information that the three exchanges provided the SEC was pretty dramatic. It was instant. They had all the information around what was happening during that period. So it was a lot different. And if you look, the SEC published their findings at the end of the year. So it came, they got the data, they were able to analyze the market, look at what happened, and we all were very responsive to that event. We all have made changes to our opens, our halts. We've all reacted because all three of us are aligned to making sure the ETF market is trading in a better environment. And so I do think we won't see a return of the 24th based on all the changes we've made, and there's still changes around how we halt our markets and reopen our markets that are coming to market. I would say it wasn't the ETF's fault. Mm-hmm. It was actually collectively our market structure was overly complicated for that event, and ETFs halting and multiple halts was really the problem.
We just a couple points to add because I agree. It was a broader issue than ETFs. We had a few stocks, three in particular come to mind on the New York Stock Exchange that traded, in a disruptive fashion, and Nasdaq as well had stocks, non-ETFs but operating companies, and then a number of ETFs. But if you take a step back, Commissioner Pivovar, you said is confident it won't happen again. The next issue is never the last one, and so yes, I too am confident that won't happen again. But that day, August 24th, by some metrics, was the single most volatile day in the history of markets. So if you look at the volatility of volatility, there's never been a more volatile day than that single day. And so you were bound to have some disruption. And the last thing I'll mention is, notwithstanding the hugs and the camaraderie, we compete like cats and dogs. It's as competitive as an industry as you will find. But it's actually one shining example, probably the only shining example, of our coming together in an appropriate way, coming together and really working as an industry to put in place a number of helpful market structure improvements that have really improved market structure, not just for all stocks, but for ETFs in particular. I won't go into the details, happy to go into the details, but it gets into nuance, talking about LULD and reopening procedures, so on and so forth.
And I think to just add on to Tom's point, that situation probably won't happen the way it happened, but I'm sure there's going to be something else. It'll be something else that was unforeseen, something else that we can't predict in the way we test and the way we model. But I think the fact that we can react to it, and I think that we get stronger every year as we anticipate and see these situations, and a lot of it's going to get down to how we look at data and how we look at the relationship between equities and ETFs and futures and ETFs, the fixed income market, what trades in dark pools push and flow to lit exchanges, all that dynamic because it is so complex. There will be something else. The question is how well can we react to it singly or together will be the question, and hopefully it won't be too painful.
If you look at the Brexit event, where we had very similar, not identical volatility on the 24th, but dramatic price dislocation in our market, we didn't have any issues. Pricing wasn't dislocated in the ETFs. It actually worked. The changes that we put in place actually work. So when we get along, we do great work.
Yeah.
I think on that Brexit day, just as a point of evidence, there were 70 what are called LULDs, limit up, limit down, where you kind of essentially have to halt the stock. Whereas on August 24th, there were 1,500. And that's a good thing. Too many of those just creates more disruption and confusion.
It's because you change your opening process to help things out.
I didn't bring it up.
What else are you
We all
working?
work together.
Yeah, you work together. So, what else are you working together
The
on?
Market Structure Advisory Committee. Oh, that's right. You guys aren't on that. Sorry. Damn. There must be something else we're doing together.
Not much, Reena. Not much.
Okay, so you just compete. I must say one of the things that worries me a lot is cybersecurity related. With
We do work together on that topic.
Yeah.
Very much so.
Okay.
And we do work together on regulatory matters as well.
Like objecting to IEX.
We do not work together on that.
We didn't
do not
work
together.
We just read each other's comment
We
letters
agreed.
with a
We
lot
agreed.
of laughs and smiles.
Yeah.
Well, in the next panel, we'll have IEX express their viewpoint, whether they want to cooperate with you or
There's
not.
room up here.
So if you want to take a break, that's a good time. Just kidding, John.
So in your minds, broadly, what is working well for the markets in terms of market structure, and where do you think changes are needed?
I'll start. I mean, I look at the top 500 stocks in the U.S., and the market caps, as Tom pointed out, are enormous. These are the most efficient markets you'll see on the planet. By far, you can't find any instrument on the planet that trades as efficiently as our most liquid stocks. And if you go to the buy side and ask them where are their challenges, it's not at the top end. I mean, there's some frustration at the top end, but it's truly mid-cap and lower, and where the spread's starting to widen and the liquidity gets a little thinner and the market becomes more reactive to their footprint entering and exiting. If you look at the ETFs and how they trade, the spreads are unbelievably competitive in these liquid instruments, and sometimes less liquid ETFs that have components that are liquid trade with dramatic spreads as well. So our market is working. When you add up the notional dollars of turnover, it's unbelievably efficient and successful, and we shouldn't really change it. When we think about market structure changes and even pilots, we need to be careful with the stuff that works. We rarely talk about what works and how to avoid disrupting it. And then outside those most liquid markets, it's really the complexity doesn't work. We're adding complexity to our market that we're going to, I think, regret the day when there's another price dislocation and that complexity either breaks us or creates confusion for investors. So I'd say we have a lot that's working, but I'm really worried about the complexity that we're adding to our market that's already complex.
So largely agree. I know this is getting a little, you're looking for some more fireworks, but largely agree. With respect to, markets are networks, just like Facebook's a network. Networks gravitate towards only having a few of them. Not just one, because markets like competition, but networks really benefit when you have a lot of participants on the network, much like Facebook. And if you're, to carry this metaphor too far, if you're Taylor Swift you can be on 50 networks and people are going to find you because you're Taylor Swift. And Bank of America stock is the Taylor Swift of the US equities market. It can deal with that fragmentation, and there's still going to be tremendous liquidity. There's going to be market makers who are getting paid to stitch together all that fragmentation and make prices for Bank of America, and they're going to be okay. But for smaller stocks, they just can't deal with that fragmentation. I go back to the point I started with, which is markets are there for capital formation. If you're that CEO or entrepreneur and you're saying, hey, should I consider an IPO? I'm a smaller company. What will happen if I approach the markets? What will happen is you'll have this fragmented stock. You'll have very wide bid-offer spreads. You won't be able to build a great big book of long-term investors. And so something is amiss there. You know, Chris actually recommended a while ago, maybe we do something where the smallest stocks actually just trade on a single venue. I think you suggested that. Now, we could quibble with the details, and I can't say it too vocally because it sounds like as a listing venue provider, you know, I'm trying to pull the ladder up behind me, or we at the New York Stock Exchange are trying to create some sort of monopoly. But we need to move towards something in this country that acknowledges that fragmentation hurts these smaller stocks with lesser liquidity, and that less fragmentation would improve capital formation and ultimately increase the number of IPOs and ultimately improve the economy.
I have nothing to add to that, but you mentioned cybersecurity, but we never really got into it. But it seems to be our board and other boards that I'm on, it seemed to be a top three kind of topic that, you know, one is, you know, educating, you know, the entire company and employees from what kind of emails they read and the phishing, and even some internal penalties if they're just arbitrarily going through an opening malware. But I think it's something that every company's got to be aware of. I don't know that it's as big of a threat that it could be. I think one of the bigger threats are that, you know, people use usernames and passwords, and you could pick each one of us. We probably have either Amazon and eBay and a couple banks and credit cards, and you have 20 or 30 logins and passwords that you use. And I think this is an actual example that happened, that it may have been within a company that they got attacked, pulled in those usernames and passwords, went out and hit all kinds of different institutions and actually got some hits. Set up accounts, trade through those accounts. So I think something like that is a danger, even though you don't really think of that as, you know, a cyber attack, but it is a form of stealing information and then using it broadly. So I just think awareness within companies, I see it, like I said, on the other boards that I sit on, there's a lot of talk about education and how do you structure the companies to make sure that everyone knows what to do and what not to do and how to prevent it.
I think the DNC is very focused on cyber these days.
That's right.
You can agree with that or not. Sorry, next question.
Next question. I would like to ask this question when Commissioner Piowar was here, but he's not.
We can bring him back.
We'll send him the message. If you had to change one or two regulatory issues to make the markets serve better, what would they be?
I'd take a hard look at Reg NMS. And I mean, Reg NMS was a true battle, whether we should have it or not, when it was passed. It was largely behind closed doors. It was very much targeted at adjusting the old specialist system and the floor model and trying to connect the electronic model and the specialist model, and it had clearly successfully adjusted that, but it left a lot of complexity, and now we're talking about access fees, and access fees were set literally in 2005. That cap was set and it hasn't moved, so there's a problem there. So I would very much focus on Reg NMS. We've talked, you've seen it in Canada, where there's a minimum market share to get a protected quote. I think we should explore that because the cost of just connecting to our market now, and you have to connect to every exchange regardless of size, and that cost of all the network costs and the data costs. So I would kind of definitely, I mean, it's been years. We need to crack open Reg NMS and take another look at it and make some adjustments, because we can't assume what we were thinking in 2005 is applicable in 2016. It's
But you
just
think
not.
you think it was good when at the time, though, right?
For what it was targeted at, really behind, I mean, they didn't say it, but what it was really targeting behind closed doors was automating all exchanges, bringing it into a faster environment. What it has become, and it didn't predict all the different exchanges and markets and medallions that the protected quote incentivizes you to have. We all have a ton of medallions, getting more, and that it probably won't stop there because the protected quote encourages you to get a medallion.
Yeah, I wouldn't really. I guess so. I agree with most of that, and I wouldn't. It's not an actual rule that I'd point to. For me, it's more about the process, and not to pick on the SEC, but I think their job has gotten a lot tougher because of the fragmentation and the thought of what if you switch this over here? What's going to be the ripple effect? But it really, is trying to run these businesses. It really slows us down, and I think it actually hurts innovation. I know that IEX got approved, and they were doing something that was different, and it did take a long time. So maybe they would agree with the notion, but the whole process just seemed to take an extremely long time. You put a rule in, your competitors can spend the next year reacting, to that innovation, and so that part of it I think is a little bit frustrating for me. It slows me down.
When we talk to customers, when I speak to customers, not just the sell side but also the buy side, they all talk about how expensive trading equities has become in all forms, and they kind of will go through a litany of the various costs. By and large, those costs have increased, and many have arisen because of what we keep referring to as fragmentation. And the fragmentation takes two forms. One, among exchanges, you see Nasdaq acquires ISE, and now they have combined 6 exchange medallions. They don't plan to shut any of those that I've heard of, and similar likely down the road with SIBO and BATS. I could be wrong about both of those. I don't have any inside knowledge. But
nope, we're not shutting any down.
Yeah, I would assume that's not the case because the incentives in Reg NMS are for fragmentation. And then the secondary form of fragmentation are off-exchange venues. And if you look, the percentage of trading now is at an all-time high on off-exchange non-lit venues, so lesser transparent venues. At some point, competition is a social good. At some point, maybe it's the 63rd venue where you can trade IBM stock. It goes from being a social good to a tax on the industry, and we're clearly at that point. And so to answer Reena's question directly, the one change I would like to see is regulation or a reduction in regulation, either one, that better motivates price discovery, lit price discovery, and in so doing will also disincentivize needless fragmentation.
Is there anybody who's benefiting from the fragmentation in terms of buy side, sell side, retail customers, institutional investors?
I think retail has it as good as they've ever had it. I think a benefit can be traders that are able to do latency arbitrage, if that exists. But the problem is, at the same time, we're asking for these market makers to be on our venues, and if I have 6, and he's got 4, and he's got 2 or 3, and then you got these dark pools, we're asking them to put liquidity in these different venues, and if they really want to be 1,000 up or 2,000 up in a security, they got to divide that by 20 and divvy that out. And so that hurts the overall liquidity. I think it hurts our listed companies that are in the middle and lower tier to attract that liquidity and have a displayed market, which the others are using the reference price to trade off, as Tom alludes to.
So I know you're competing amongst yourselves like anything, but what is one big issue or a couple of big issues that each of your exchanges is facing? Challenges?
I mean, look, we all compete for ETFs. It's the one place where we do list. I think getting ETFs approved, and Commissioner talked a little bit about it, it is, when you look at the SEC, they have the investment management group, which is really designed around mutual funds. And here we are living through this shift of capital from mutual funds into passive but more ETF products. And the SEC has to position itself to actually deal with that because it's coming fast and furious, and the number of products that we are all seeing is pretty dramatic. And we're just on the edge of what we call the semi-transparent active ETF, which is really just taking a mutual fund investment strategy and putting it in an ETF wrapper. And it's something that the Commission's struggling with, and there's a number of proposals floating through there. Once we find the right structure for that, where there's some marry of some level of transparency, but you still want to give the portfolio manager the ability to pick and choose their portfolio without showing the world, I do think you'll see an explosion of more ETFs coming to market. And so it's really the process around how we all get these ETFs to market. We each have to file a rule filing for every new ETF that comes to market. There are some that meet standards that we already have approved, but that process of filing, that inefficiency, I'd like to see it really opened up and create more generic filings so 10 ETFs can come through the same filing, or if any one of us has one, we all can file any of those ETFs. So.
There's no one or two for me, but the framework I think about when I wake up in the morning is product, competition, regulation is kind of the three big buckets for me to spend time. And by product, it's how do we make ourselves a more attractive listing venue? How do we make ourselves a more attractive trading venue? On the trading side, we're in the middle of a 5-year plan to overhaul all of our systems, to throw out what were essentially 20-year-old systems and put in a new state-of-the-art system that'll just be much simpler and easier to understand and more reliable. On the competition side, it's as I said, it's vigorous. Every new ETF listing, every new corporate listing, we're going toe-to-toe at all times. So just always trying to figure out how can I get a leg up on a particular deal or with a particular customer. And then on the regulation side, it's trying to understand, okay, what do we have to implement today? And that's head spinning. I mean, there's always many things we're working on that could go wrong. We had one recently, the tick pilot, that was due to go live, I don't remember, last Monday, the Monday before, something like that. And literally the day before, I think it was Friday, we're hearing from the regulator, hey, nope, we don't think you've complied with this tick pilot, you need to change it. And it's like, we can't just change on a dime and dealing with those fires. And then also with respect to regulation, hey, what could kind of really mess up these markets in the future? And that's where we're looking at some of the same issues that Professor Angel asked Commissioner Pivovar about, such as this proposed access fee pilot.
Yes, there's no doubt that on the listing side it's a battle, but I think a wrestler can beat a baseball player any day as long as he puts the bat down. But so that is a bloodbath.
That's a big caveat.
Yeah. I guess when you ask the question, I don't really think of them as problems, but I think there's in our mind we have a lot of things we want to do, and it's difficult to prioritize and get the technology resources in a way that you can capitalize with your resources and spend your money in a smart way. We're doing this ISE integration, so there's resources there. There's this new order type, this ELO order type that we think is innovative and good to bring to the market in our equity markets. Then you have all these regulatory projects like the tick pilot and last minute stuff. So for me, it's more about managing those resources and priorities and making sure that I'm making the right decisions for our shareholders and for the company.
So before I open it up for questions, I'm sure one of your big resources is human resources. And a lot of Georgetown students, some of whom are here, would love to come work for you. What are you looking for? What kind of skills should they have?
Sorry, we're not in the computer science center, but we're definitely looking for, you really need technologists. I mean, that's where we spend most of our time searching and looking for talent. We have a very small footprint, only just over 300 people. A lot of those are in Kansas City, so if you want to live in Kansas City, it's a great place. But it's, I think all three of us spend a lot of time on technologists because of the demands that are put on our systems and the bandwidth that we use and the message traffics that we see. You're constantly innovating with getting no credit. And so it's that type of talent that we search long and hard for. So sorry.
Just to kind of come at it from a different direction, soft skills, what I look for. I mean, we all, those of us in our career, as opposed to the students here in the room, we all wake up every morning, and some days you've had a bad day. Maybe you've had a fight with your wife, or you're feeling sick and you don't want to go to work, but you got to go to work day after day, week after week, year after year, decade after decade. And so
It's kind of depressing.
It is. It is. And so my general approach with work, and this applies to my personal life as well, is you got to turn it into a game, and you got to wake up, and it's got to be fun, and it's got to be a competition, and you have to ask yourself every single day, how can I get a little bit better today? And I want to surround myself with people, and we look to hire people that view it the same way. You can have all the work-life balance you want, as long as you're obsessive about being successful and competitive and winning. As long as you're a business junkie, you're trying to get better at what you do every single day. And frankly, you're fun to be around. You're somebody who's pragmatic but optimistic. You enjoy the victories, your colleagues enjoy your company, and those are with respect to the soft skills, that's what I look for. When I ask to interview somebody, by the time it gets to me, they better be competent in their field of expertise. And if they're not, we've got a larger problem. And so that's what I'm looking for. And I'm asking them questions, hey, what gets you out of bed in the morning? What interests you in our exchange? What do you think about Nasdaq? And when people, what's Nasdaq? Get out. I don't have any interest I don't have any interest in you. It speaks to how widely known Nasdaq is, which
Do you ask them?
which is comforting.
Do you ask them what's bats?
Zero chance they know that.
Only the baseball team knows that. Yeah.
So anyway,
Yeah, just aggressive, competitive people. That a lot of them are going to have to be statistically and computer savvy individuals, but they do have to have, I don't know, I'd call it a type A. We have to win. We have to kill these guys. It's competition and looking at data, being statistical, being comp sci oriented, and self-sufficient too, self-motivated. Not someone that you've got to say, hey, can you do these next thing? I love people that say, hey, Tom, I was thinking about these 3 things. We can do these different things. We can look at this business. We can look at this pricing, this functionality, going to talking to customers. So I think that's something we look for. I need people to help me get to where I want to go, and those people are the ones we need.
Great. With that, we'll open it up for questions. Please come to the mics. There are 2 mics, one on each side. If you line up, just go ahead and line up with the mics right here.
So you can't see.
The next person, feel free to be in line on either side.
Boy, the lines are getting long.
Hopefully they will. Go ahead, please.
Hi, my name's Charles. I'm going to probably sound a bit out of left field if I'm sorry to mix my sporting metaphors as a Brit.
that works.
But I'm interested, as a compliance and risk professional who acts globally and things, I'm just interested, obviously compliance and risk is obviously not necessarily the most popular thing to give with regulatory change. And I'm just interested to hear, you spoke a lot about the developments in the US markets, which I naturally understand. All 3 of you are active globally, and particularly in Europe. Just interested to hear your international perspectives, given the fact that you have all 3 of you have been growing and merging and consolidating and taking over businesses, and just interested from that perspective.
We're in Europe, quite large in Europe, and one thing about Europe that I found is we talk about regulatory change here in the U.S., and there's been discussions about changes around access fees. Europe's been implementing the MiFID II for the last 6 years, so we've also pushed it out again. So there's actually great regulatory stability in Europe because we just keep pushing MiFID II along. So you can't change it until it gets implemented and we can start talking about it. But I look at Europe and it's a phenomenal market. There's some lessons for us in Europe. They don't have Reg NMS in Europe. We have to compete for every share, every order, and it's not as fragmented. There's ATSs that come to market in Europe and they die, unlike here in the US where ATSs come and they seem to survive despite not having a lot of market share. So the European model does actually work. Certainly best execution is now becoming a rampant topic throughout Europe, both before MiFID II, but also it becomes heightened after MiFID II. So I think there's some lessons for us looking out at Europe where we could make some adjustments on our own market.
And I think in some ways we're behind Europe, and there's some process improvements that are actually going on in Europe that aren't going on here. I mean, you see a lot more in Europe about second and third line defenses within a company, and that really isn't even a notion you have here in the U.S., and I think that it will because it's helpful. I mean, here in the U.S., you know, to be listed on the other exchange, you don't even have to have an internal audit function, which seems like one of the most basic functions possible. And whereas in Europe, that's something that would be kind of scoffed at. So I think there's some basic tenets that will move across the pond. My concern, however, is that Europe is looking increasingly inflexible with respect to the compliance and risk regime. And we all know the next problem ain't going to be the last problem. And so you have to preserve some degree of flexibility to be able to act in a crisis. And so that's the one the one trend in Europe that I hope from a compliance and risk perspective that doesn't jump across the pond, this sort of inflexibility on not just exchanges, but operating companies and financial institutions as well.
The market structure there, at least in the markets I'm most familiar with, are very different than the U.S. markets. As Chris mentioned, there's no notion of like a Reg NMS where you've got the exchanges linked together, and you also have separate clearing agencies there. So that, I think, creates a different regulatory environment, probably one that may need to change, but also, as Chris mentioned, MiFID II, I think, has got some good components in it, and I feel like, their ideas, I think, are a little bit progressive. The implementation of those ideas are a little bit behind, in my opinion.
Hi, thanks for being here, first and foremost. So I think post the crisis, there's been a lot of talk on too big to fail, and I think that's something that a lot of folks, whether from a retail standpoint or from regulators, have been thinking about. And maybe in the context of talking, as you mentioned earlier, efficiency, bifurcation of markets, segmentation of markets, how do you view exchanges vis-a-vis your colleagues, let's say in the banking industry, or maybe on the opposite end, clearinghouses and utilities? How do you view the role of exchanges in the way they're currently structured as it relates to this issue of too big to fail?
Well, I think we got it easy in the financial crisis, because if you look at really the theme of that crisis, it's let's put things on transparent markets, let's move things into clearing. It's all the attributes that we all have where our product's on exchange and cleared, whether it's a future or an equity or even an ETF. So the theme around the globe has been clear it first, hopefully put it on a transparent market, and all things will be good. Now, the next, really the second piece of that was, oh, by the way, you have to change your balance sheet. And you have to put in place a lot of guards and capital efficiencies. And that ultimately, that piece, the balance sheet requirements, and it's whether it's Basel III or Dodd-Frank, has changed our markets. So we talked about treasuries, we see it in FX, we see it in equities, where the balance sheet is willing to go, and it actually has an impact on the price formation process. And I think that was missed, and we're now seeing the ramification of that.
Nothing to add.
Yeah.
Very good. Thank you very much.
And I think that's going to be all the questions we'll be able to take. If other people have questions, please
poor Jim's
hang
up
around.
there.
No, we're going to take these four. We're going to take these four, but just don't want more people to line up. Our panelists will be here, so I'm sure you can chat
We'll just be here
with
on the
them.
couch.
Great, super.
Ask this question.
Thank you very much. I find it useful to contrast and understand the differences between competition among and between investors as compared to competition among and between exchanges. And I think once we saw NMS being implemented, we saw an exponential extension of complication in terms of execution, timing, and quality. Indeed, I think one of the quotes that I read recently was really right on the money. There was a institutional portfolio manager who said that dealers do not make markets liquid, investors do. And thinking about NMS, indulging in a daydream here for a moment, what if the SEC were to permit a pilot program that would allow issuers to opt out of NMS? If you think about that, I'm curious to see how you folks would anticipate what the reaction to that would be.
I think that would actually hurt liquidity if they were to opt out of Reg NMS. I think we'd have less market makers making a market there. I think one of the things that I think our listed companies, and I think largely the public doesn't understand, is when you enter an order to buy or sell something at the market, it mostly does not hit any one of our exchanges. I'd say 95% of the time that does not hit our exchange. That's traded in a bilateral market maker dark pool and reported to a trade reporting facility. So to the extent that you have more and more of that, I think it's less and less of an incentive for market makers to want to be a displayed market. So I think if you take that incentive away, if I understand your question correctly, if you take that away even to the extent it's there now, I think it will hurt even more.
Yeah, I think it depends what what's behind door number 2. So if you opt out of Reg NMS, what are you opting into? But it's an interesting question, and in fact, when I was referring to the idea that Chris proffered a year and a half ago or a year ago or something, in my mind, it would be at the issuer's discretion, and so it is along the lines of what you're describing. Hey, I'm a new company, I'm coming to market, I'm going to have a market cap of 350 million, not 35 billion. I want to opt out of the obligation for my stock to trade on many, many different venues. I'll give it a shot. If it doesn't work, then I'm a sophisticated CFO of a public company. I can reverse the decision. I can look at the data. So I like the direction you're
So
headed.
opt out of UTP, though.
Yeah, just UTP as opposed to all of NMS.
I think that could be helpful.
So you guys are they're supporting my proposal, finally.
As long as it's
We're working together again.
For the record, Chris's proposal included 0.02% of the assets in the United States, of the market cap in the United
risky
States.
business. He's a risk taker.
It was a
that
pilot.
to me was a-
it was
that
just
to
a
me-
pilot. We want to start small.
That part was silly, but the idea was a really good idea.
Jim?
Next question.
The market data.
Jim,
The
you can
U.S.
move the mic down a little bit.
And I am standing up. The U.S. and the EU have very different policies towards market data for equities. And all of you operate trading platforms in both jurisdictions. So with your experience dealing with the different market data regimes, if you were a benevolent dictator and could dictate any market data regime, what would it look like?
You would only consume Nasdaq data.
I said a benevolent
I
dictator.
think that's what they're doing already.
I'll go first. I'm going to answer your question a little bit elliptically, but you can kind of pin me down with the hypothetical. I think market data is kind of widely misunderstood, and part of this is and we can talk about the next panel, is IEX's narrative, and which is somewhat vexing. And IEX, which is this new competitive exchange, fairly small, but has a very large voice, in part because Michael Lewis chose to write a book about them and others, but them largely as the protagonists. And they've created this narrative that you shouldn't charge for market data. You should effectively bundle it with the cost of the match. And they charge this extraordinarily high fee for matching trades. I don't know their exact all-in cost, but it's something like 15 cents per 100. Whereas we choose to say, hey, we're going to charge you a reasonable rate for the match, and we make round about 5 cents per 100, which is probably higher than our competitors, but not too much. And then we're going to charge you for market data if you so choose to purchase it. And the costs of market data they're substantial, but they're elective in many cases. And they're substantial because of this fragmentation. That's what happens when you have fragmentation. Fixed costs go up. And then similarly, if you want to locate your servers near our servers, we will guarantee that you're an equidistant amount of space away from the exchange as every other customer. And that's another service you can provide. And I take pride that about 95% of our volume comes from customers who buy our market data, our proprietary market data, and 90% of our volume comes from customers who are co-located, have a co-location facility in our data center. IEX has come along and they've said, hey, we don't want to provide co-location. We'll leave it to the most sophisticated traders to try to get the closest possible spot to our cage, creating an unequal playing field, which is odd to me. and they're saying, hey, we shouldn't charge market data, but really what they've done is just bundle the match and market data, and their all-in fee is much higher than all of our fees on a per share basis. You can add our market data, you can add the tape, the proprietary data fees, the co-location fees, put it all in a pot, and you get to a much lower cost. And so I feel very good about market data. I know I'm giving you a bit of a long answer, but just to conclude, I feel good about the way market data is working because I see how competitive it is. And I'm going to give you an anecdote that you might find interesting. There is a customer that has lots and lots of retail customers. You may even have heard of them. They use the consolidated tape in order to satisfy their obligation to provide data to their customers. They then, Nasdaq innovated on price and product, and they then said, you know what, I'm going to go to Nasdaq, because Nasdaq's innovated on price and product. And then we innovated on price and product. That same customer went to us. They dropped Nasdaq, came to us, we innovated on price and product. And the latest is, these guys innovated on price and product, and that same customer, they dumped us, and they went to these guys. This is one single customer that just comes to mind right now. I know you guys may be able to think who I'm referring to. And that shows you the competitive dynamic that's going on in terms of innovating in terms of price and product.
They just dropped Chris, and they're coming back to us.
Oh, yeah?
Yeah. So that's, the beauty of competition.
I have to add to that because, and sorry guys, we'll get to your question, but the irony of IEX is not only do they say, market data, we don't charge for market data, they became an exchange so they can tap into the SIP and take millions of dollars of market data revenue. So there's just a twist of irony here, and they're anti-colo. Again, there's people that are coloing near IEX, so their hop doesn't really change that. It's still who's first to the front door. But their pegged order type, where they pump in fast feeds, is virtual colo. So they basically they offer colo. They just do it through an order type where they slow down the taker and give proprietary feeds to this order, and they speed up how they can trade. That is colocation.
A dark order.
It's just a colocation, virtual colocation inside their exchange. So the ironies are falling all over themselves.
John Ramsey, you're in the audience from IEX. You will be up here. We are an equal opportunity conference, so we will make sure that.
But he didn't go to Georgetown.
Yeah.
I should get an advantage.
But all our panelists, you're part of the Georgetown family now. So we will make sure you have a voice and respond to these three who are ganging up on you. Next question, please.
Hi, Anu Sharma with Morgan Stanley. A lot of the clients that I work with are investors in the marketplace, and it's very hard for me to find a client who doesn't have a sour feeling about the markets in general. And you think back, you look at Reg ATS, Reg NMS, decimalization, the markets have gotten extremely, extremely fast. And a lot of the people that I deal with feel like it's an unfair advantage to the average investor. So my question to you is there any benefit to slowing down the market? Is there any benefit to maybe, and it may never happen, going from decimals to nickels or something of that nature, but what's out there that would make an average investor feel like the markets are on their side versus not being on their side?
I totally agree with you with respect to the perception. I had a 106-year-old great uncle who lived right up here at Hawthorne and Foxhall, and when we agreed to buy the New York Stock Exchange, came out in the paper, he called me and he said, Tommy, what are you doing getting into the equities business? I don't trust the equities business. Literally the very first thing that he said. So it absolutely is a problem, and I don't think at this moment it's getting better. Because the market's getting more complicated with speed bumps, and now there's new speed bumps, and there'll be some other speed bumps, and I think people probably feel it's more fragmented and complex than ever. The one thing I would say is people really talk about the speed in a fearful manner. However, keep in mind, it used to be, literally, I'm not making this up, who could get the stall for their horse as close as possible to the New York Stock Exchange? Fastest horse and the stall closest. Then it became who had access to the telegraph, the telephone, the internet, now it's wireless. That is the natural evolution. What I think actually is going on under the covers is all of the fragmentation, the speed combined with the fragmentation, where the investor feels like, I don't know exactly what's going on with my orders zipping around to 20 other venues. And when you don't know what's going on, you assume something bad is going on. You assume there's bad motives. And so for me, if we can solve the fragmentation problem, and putting an order on E-Trade or Scottrade or Fidelity or Schwab, I know what's happening, then I feel a lot more confident. So that's where we've been focusing our effort.
And after the Flash Boys book, I came down and talked to some individuals on the Hill, and I actually had one individual tell me that his father believed that if you sat down at, say, an E-Trade or Schwab computer, or you logged into his broker-dealer account and started typing in buy 100 shares of IBM, that the high-frequency guys, the Boogie Monster high-frequency guys, were actually knew that order was being typed in as it was being keyed. And I got to tell you, I didn't know where to start in the conversation and trying to dispel that. It's tough. I think it's an education process. I think the markets are better than they've ever been. I think customers should use limit orders, not market orders, especially in times of volatility, but that's a whole education process in itself. And it's, one day at a time, one investor at a time, one person at a time. And it's not easy.
I got nothing.
And our last question.
All right, thank you. First, thank you very much for a really engaging panel. You guys have been really forthright. It's been great to hear you talk.
It's the couch. Make you tell the truth.
There's no media in the room, right?
Right. So a question about fintech. I'm wondering how fintech is affecting your organizations and what you're doing to kind of incorporate some of these new things into your operations and services you provide. Some of that I know is focused on the institutional side, kind of the back end, settlement and blockchain, that kind of thing. But since we're here at this university, I'm wondering if you could also talk about what you're doing to address, this generation of people coming to universities like this that are completely savvy with social media and mobile computing, and how that's going to affect the investing experience and what they're going to be looking for from exchanges.
I'll take a quick shot. I think Nasdaq is seen and known to be a technology company. We deploy technology across all asset classes in the best way that we can. We have a market technology business where we sell systems around the world to exchanges that want to start up. I'd say in the way that my teams run their business every day, we're looking at machine intelligence and looking at data so we can figure out who's trading with each other and how we can affect better pricing models. So we're using technology across watching our P&L, looking who's trading with each other, deploying that kind of technology in our surveillance systems, and in our market technology business when we sell technology. So it's a huge part of what we do every day. Our CIO is very engaged in that. We talk in our off-site strategic planning sessions. We carve out a couple hours for those discussions about where we can take a look at new technologies, where to deploy them, including blockchain. Where's the best place to deploy that and learn about that? But I think it's the backbone of what we do.
I think for your students, technology, the improvements are really incremental. If you read the papers, you get the sense that they're revolutionary. They're really incremental. They're incrementing fairly fast. But even blockchain, especially for how it will ultimately be used in financial services, it isn't revolutionary. It's a ledger that can be replicated, more quickly than existing ledgers. The thing that I think you can point students to where they have a natural advantage is the digesting of that information is changing in a revolutionary way. The move to mobile has been total and complete over the last 5 years. And I just met with a CEO of a very, very large foreign company, $60, $70 billion market cap, and they're doing everything now for mobile, and they're allowing their users to buy money market funds, to buy insurance, to check banking accounts, to process payments. And so I do think the revolution is going to be in how people digest, and the really smart kids who can figure out how to take the incremental advances in technology, the revolutionary changes, and how it's being consumed, and combine all these apps and create kind of mega apps are the ones who are going to be really wealthy 10 years from now.
I'll just add to that. I think the life cycle of how we trade is changing dramatically, partly because of the products that we're investing in. And I tie it back to market data. The idea of staring at stock quotes is going to fade. People are going to stare at price portfolios, and they'll be on your phone because you can't look at too many stock quotes on your phone. You're going to look at your portfolio. You're going to look at portfolio adjustments. So that whole life cycle of how we invest and how we trade is dramatically changing because of, as Tom points out, the mobile explosion. I mean, you walk around this campus and kids are just walking with their phones in their face. That's reality, and that's how they're, I mean, and with the brokerage costs dramatically dropping, for the first time in our investing career, there's brokers that are reaching your students. Students are actually broke. Tom didn't even have $1 to buy a Gatorade. Tom now, if he was here, would be able to have a brokerage account, and he'd be earning $1 to buy Gatorade. So I just think we're democratizing who can invest, but we're also changing the life cycle investment, and it's a portfolio investment now. It's a weighting of your, where you think your biases should be. It's much more sophisticated because your phone's telling you how to do it.
On that note, I want to thank our panelists for this very engaging discussion.